Index universal life insurance policies are long-term propositions and shouldn't be entered into haphazardly. But 30 different life insurance carriers offer IUL, so how do you determine which carrier is right for you? That's what we'll be talking about in today's video. First, we must acknowledge that not all IUL carriers are created equal. Just like you didn't get married to the first person you ever went on a date with, you shouldn't blindly enter into an IUL contract without having a laundry list of attributes you're looking for. There are often wide disparities between the good carriers and the bad ones. In fact, in a recent video I did, linked in the description below, I explained that there are at least 5 qualities or attributes your IUL must have if you plan on spending the rest of your life married to it. Those qualities are a guaranteed 0% loan, interest in arrears, daily sweeps, an overloan protection rider, and a chronic illness rider. If you want to review why all of those attributes are indispensable to your IUL, you can find the link to that video in the description below. But here's the point of this video. Your IUL could possess all 5 of these attributes and still not be the IUL you should be married to for the rest of your life. So today, I'm going to impart a secret key you can use to determine if a given IUL carrier is one with whom you should be engaged in a long-term contractual relationship. And that secret is revealed in the response to 2 very important questions. These questions speak to the morality and ethics of the IUL carrier. First question, does the carrier raise caps on their in-force books of business? Okay, what do I mean by this? First, we must acknowledge that IUL carriers are not contractually required to keep their caps high or stable. In fact, if you look through your IUL contract, you'll see that there is a guaranteed minimum floor for that cap, and it's typically between 3 and 5%. Why do IUL companies establish these types of floors? Because to a certain extent, they are beholden to economic forces that are beyond their control. Let's talk about what those economic forces are. Every cap for every IUL product with every carrier is essentially determined by a series of economic variables that include option costs, determined by market volatility and short-term interest rates, and a carrier's option budget, which is determined by the returns on their long-term bond portfolio. So, if a company lowers their caps on their IUL products, it isn't necessarily because they're bad actors or out to burn their policyholders. In many cases, they are just reacting to the changing economic variables in the marketplace. But here's the key to finding a good IUL carrier. What does that carrier do with the cap rates on their in-force policyholders once economic circumstances change for the better? If their option budget grows and market volatility falls, 2 of the big drivers of higher cap rates, do they raise caps on their in-force policyholders? Do they do the right thing even though the contract doesn't require it of them? Now, it's not always easy to exact this type of information from carriers, but I happen to know people in the higher echelons of some of the very best IUL carriers in the industry, and they shared with me the history of cap rates on their in-force policy holders. And I have to tell you that it's extremely encouraging to see a prolonged history of them raising caps on their in-force blocks of policies when the economic circumstances allow for it. In other words, there are companies who have all 5 of the required attributes that I listed at the outset of this video, and who do the right thing by their clients, even when they're not contractually obligated to do so. So it's very important that you find a company that does the right thing when economic circumstances allow for it. The second question you should ask of your IUL carrier is this: do they have a history of sucking consumers in with high first-year cap rates and then dropping those rates precipitously once they've got them in their clutches? I talked about this unfortunate phenomenon extensively in my best-selling book, Look Before You Lurp. Take a listen to what I had to say. Have you ever jumped at a credit card rate that offered an impossibly low 9.9% introductory rate only to see that rate shoot through the roof once the honeymoon period was over? Chances are you proceeded a little more circumspectly the next time you got one of those offers in the mail. Well, the same type of caution should be exercised when evaluating the index caps of an index universal life policy. Keep in mind that most well-regarded IUL companies offer index caps from 11 to 14%. This is what they were, by the way, when I wrote the book. They're a little lower now. Caps in this range allow you to truly participate in the upward movement of that stock market index, while at the same time enjoying the downside protection of a 0% floor. Think of the implications, for example, of having only a 4% cap during a year in which the S&P 500 grew 20%. You'd be kicking yourself. One of the most attractive features of the IUL would have been rendered moot. I've seen instances where companies offered an 18% cap rate only to drop it to 10% or worse soon thereafter. Not much different than how credit card companies lure you in with deceptive introductory rates. The name of the game when it comes to caps is stability. Do they throw out teaser rates just to get people through the doors, or do they start with more realistic cap rates and keep them level, stable, and sustainable? I'd much prefer to have a 12% cap rate year after year than to start at a 20% cap only to fall to a 9% cap when the honeymoon was over. So today we've talked about 2 ethical and moral litmus tests you can apply to your prospective IUL carrier. First, do their cap rates respond nimbly to the economic forces that drive them? In other words, if companies lower caps on in-force policies when the economy forces their hand, do they then raise those caps once the economic environment allows for it? And second, do they strive to keep their cap rates relatively stable? Do they lure you in with unrealistically high cap rates at the outset only to drop that rate precipitously when they have you in their clutches? Or do they start you out with a more realistic cap rate and then keep that cap rate relatively stable moving forward? If you would like some help finding an IUL that fits the qualities I talked about in today's video, head on over to davemcknight.com and click on the Work with David button. I'm happy to lend a hand. If you have any comments or questions, feel free to drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.